Okay, let's see if we can unmuddy this water about bonds. I've got about 5 sheets, maybe 4 sheets to show you, and each sheet is going to progress to the next level of bond. So be patient and write down questions if you have them as I go along. First one we're going to look at is a bond that is issued on the same day it's authorized. This is, in a perfect world, the kind of bond that every accountant wants. The bond is at 12% for 10 years, and it's written up as a contract, so once it's written up, that's the way it stays. It's going to be authorized on 1/1, and it's going to be sold on 1/1. The interest rate is 12%. It's going to have 2 interest payments, one on June 31st and the second on December 31st. So that's kind of the background. So let's kind of look at this. What's going to happen here? Well, if I sell this, I'm going to get $100,000. So I'm going to have a debit to my cash. I'm going to have a credit to my payable. And on in June and December, I'm going to have interest payments. So I'm not sure why I have a credit there. Take that away. And you're always going to debit interest expense, and you're going to credit your cash account. So what does that entry look like? Let's go down here. This is a perfect entry. Everybody understands this one, but I just want to show you where we start at. Keep this timeline in mind, because we're going to use it in the next one. So you're going to debit cash. You're going to credit the payable. And then in June and December, you're going to do a credit to the cash and a debit to the interest expense. Fairly straightforward. I don't think anybody has any problem with that. So let's move to the next one. And this kind of caused a little bit of angst amongst everybody. This bond, okay, is authorized on January 2010, but it's not sold until 4/31/2010. Again, the first payment's on June 31st, and the second one is in December. Pretty much the same scenario you have up here, only it's sold in April. So what does this mean? The only big difference right here is it's authorized on 1/1, it's issued or sold on 4/31/2010 with accrued interest. What does that mean? That means that the people or the person purchasing this bond is going to pay for this 4 months of accrued interest. And this is what really threw everybody off, because when I'm come down here to make an entry for that, I'm going to credit interest expense for that $4,000. But let's come back up here first. So what accounts am I going to use for this? Well, it's the same accounts that I used for the first one. I've got cash, I've got bond payable, I've got interest expense. The difference in all of this is this bond was sold 4 months into the bond. Now, if somebody borrows, or if I put out money, am I going to pay interest on that bond when there's 4 months here when I was still holding it? No. You're not going to do that. But the bond is set up. It's been indentured. Its contract says I will pay $6,000 here and here. So how do I change that? I can't change it. What I can do is adjust my interest expense here. And by having the buyer pay for that accrued interest at that date, that allows me to be able to do that on the books. And it actually turns out quite well. So I'm going to receive $104,000 in cash. $4,000 is the interest. So they're going to pay for that. I'm going to credit my bonds payable, and I'm going to credit my interest expense. Excuse me. Again, on June 31st, I'm going to come down and I'm going to pay the $6,000 and put it in interest expense. And this is what it does. I already have a credit in my interest expense. Now I've got a debit. Now if I net those two, it leaves me $2,000 in the debit side, which is exactly what they would pay, or what I would pay, what we would pay for interest for April and May, or for May and June. 2 months, $2,000. So see how it balances it out? I have a tickle in my throat, so I'm going to sound a little bit funny here. So can you see why you would credit that expense? They did not have that bond for the full 6 months, so they will not get paid that interest for the full 6 months. But the way the bond is written, I have to pay the $6,000. So they're going to pay $4,000 for that accrued interest. And it is a little bit confusing until you see how it balances out from here to here. Okay, that is a bond that is issued after it's authorized. I picked 4 months simply because it's easy to play with. It could be anywhere during the year. So that, I hope, clears that one up. And now we start in with your favorite ones. This is a premium, a bond sold at a premium. And basically what that means is the bond is authorized and it's issued, and it could be at the same time, but between the authorization and the issue, or between when the bond was written up or whatever, the face rate of the bond no longer matches the market rate. And in the case of a premium, the market rate is lower. And that's what allows, because this bond is probably at 12%, and let's say the market's at 10%. So people say that's a 12% bond. I'm willing to pay more for that. So all of a sudden, this bond is going to sell for what they call 102, or it could be 104. It could be I'm just picking 102 because it's another easy number. So remember, when the market rate is lower than the face rate, the bond is going to sell at a premium. This bond is going to sell for 102, which means I'm going to get $102,000 in cash from the buyer. Now, I have a bit of a problem here, because that bond face value is what I have to show on the bond payable here. My interest payments are not changing. They're going to be the same. But I have to do something with that $2,000. And that's where you're going to create another account. And it's going to be a premium, and it's going to be a credit account. And this is going to be a contra account to the bonds payable on the balance sheet. And your basic goal of now amortizing this premium, because we want, at the time that this bond will be paid off, this balance here to be zero. It has to be zero, so that we're only paying off the $100,000 bond. And I'm sure that's clear as mud. The reason that you've got the premium is because the people are willing to pay more, because the bond returns a higher rate. Keep that in mind. So in essence, that premium that we're getting is added interest that's not showing up over here in this payment. So let's kind of see how we handle this. So my timeline is the same. We issued it and authorized at the same time. You've got your interest payments both at the same time. So now you've got a credit for cash. I've got a bond payable, and I'm allowing for that premium. So now comes my first payment of interest. I cannot change that $6,000. It's $6,000. It's written in the contract. What I do have to do, though, is allow or amortize this premium. And we do that on what this one is called a straight line amortization. So we're going to divide it by 10 years. And since we're doing 6 months payments, we're going to cut that 10-year in half. I mean, we're going to cut the $200 per year now. Divide that in 2, and it's $100 per 6 months. So now we're going to amortize because we're going to match and allocate this new interest out over the life of the bond or this premium. So I've still got to pay the cash of $6,000, sorry. But I have to debit my premium now for that amortization. So that comes to this 100. My interest expense goes down because I'm seriously not paying out that $6,000 for interest now. Did that make sense? This $6,000 payment has been adjusted with this $100 premium when it gets to the interest account, interest expense account. So now this has gone down 100. This is no longer 6,000, but 5,900, taking into account that added $2,000 that we sold, or the premium that the bond sold for. Does that help a little bit? Now, on the flip side, let's say I have issued a bond, or I've authorized a bond at a face rate that is now lower than the market rate, or the market rate is higher. Now, nobody's going to want to buy my bond when I have a lower market, lower interest rate. So I'm going to sell that at a discount, and I'm going to sell it at 98 this time. So now I have a discount, and we're in the same situation we were in with the premium. Only now I only have $98,000, and I have a $100,000 bond, which I cannot change. So now I'm going to have to create another account. It's called a discount. And that too is a contra account to that bond payable to show the value, the book value on the balance sheet. So 2,000 from 100,000 is 98, correct? So now this is what our entry looks like. We have a cash at 98,000. I have my discount set up at 2,000. I have my bond payable at 100,000. This meets my contract, this shows my cash, and this balances out, and shows that I'm actually, this discount is actually sort of an additional interest expense, because I didn't get the full amount this time. I've kind of built in that interest expense in there. So now it comes time to pay this payment. Well, I'm going to pay him $6,000, right? I've got to amortize that discount just like the premium for $100, so that becomes a credit, and it will drop this one down. My interest expense is now $6,100. See how that's allocating out that additional discount across the length of the bond? So that's kind of an overview of discounts, premiums, accrued interest, and a regular bond. Now, what is so confusing for all of this is because we start with this. We move to an accrued. On top of the accrued, we then tack on the difference in market rates. And you end up with a problem or a bond that has all of these. It will have an accrued interest, and I think we just did one, I can't remember the number. We had one that had accrued interest and was selling at a different rate, and actually sold, I think it was in April. So you also had to adjust your amortization at that point. So you can see why these are so confusing, because you're dealing with a very straightforward transaction. We add in a timing difference, and when you buy it, and then you add in a market rate versus face rate. So there's 3 or 4 variables that you're trying to keep track of. Now, in the next one that I give you, we're going to look at effective rate, the effective interest rate method, which just technically is very much like this, only it adds an amortization table to help you reflect the market rate in a better sense for your interest expenses. GAAP likes the effective interest method. If the straight line method and the effective interest method are the same, I mean, if you have very close on the numbers, you can use the amortization, or the straight line amortization. Okay, that solves that one. Please email with questions. I hope I haven't made it any worse. I hope the waters are getting a little bit clearer. Keep this video, and I would watch it right before you do the test. I'm going to try to keep the test as simple as this looks right now. Okay? Thank you for your patience.